We are speaking this week with the head of the Canadian Association of Alternative Strategies and Assets, and he is going to help you understand the role of alternative assets and strategies in your portfolio, how they've grown, and what the future might hold. So this is a really great opportunity to clue into what's going on and what's coming down the road with regard to alternative assets and their role in a portfolio for you.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John Goey, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with James Burron. James is the founder of an organization that was created by him in 2018 called the CAASA, which is the Canadian Association of Alternative Strategies and Assets. How are you today?
Very good, thanks. Yeah, we just call it CAASA. Me CAASA, Sue CAASA. It's a lot faster and easier.
That's great. A lot of people are not familiar with CAASA, and specifically, you have a designation that I have had one other guest with the designation, which is the CAIA.
Yeah,
can CAIA. By having you explain what the CAIA is?
Sure. Yeah, I got my CAIA back in 2006, and I've done grading and exam counsel and all this kind of stuff. So basically, it's like CFA level study for all alternatives. So they kind of assume that you know about stocks and bonds. It's not for portfolio managers. So that's CFA, obviously. That's required by law, CFA 1 to be a portfolio manager in all of Canada. But CAIA is private equity, venture, real estate, lending, all other private market, like real estate, hedge funds, liquid alts, music royalties, farmland, crypto, and digital assets. So everything except for straight stocks and bonds, but then it assumes that they're part of our portfolio. And then how they work in the portfolio. In the beginning, a lot of people in fund of funds used it. And then pension plans. Now single family offices are a big grower. In Korea, designations are a big thing. And so I was just in Korea, and there's a lot of folks there taking it. It used to be a third of the charter holders were in Switzerland, and now, because of the fund of fund business, and thanks to Madoff, we maybe talk about bad decisions later on. And now it's like in the US and all over Canada. So it's gone from being nothing to being, hey, kind of know what this is now, which has kind of been like CAASA too.
So let's just stay with CAIA first. So how many CAIA charter holders are there worldwide? Do you know?
I believe there's 14,000. So it's like CFA back in the 70s. So it's really young still. You have to find it. Before, when I did it, you had to find it out. Like I saw this guy Alex Eineken, who was at UBS, who started writing some things, and he had this CAIA, and I was like, what the heck is this thing? So, at some point you may start your job and they throw the books on your desk and say, go John, you got to get this thing. But right now it's more for the those who are really into alternatives are getting it. And it's a great foundation. You learn a lot about a lot of things. And I literally got a job because of it, because of the knowledge I had. They didn't know what CAIA was, but I knew enough about private equity and real estate to be slightly dangerous, so I got the job. So perfect. It's a pretty cool thing to learn.
So you founded CAASA and you co-founded CAASA in 2018. Yeah. And what CAASA says is that you're bringing Canada to the world and the world to Canada. So what does that mean exactly?
Guilty as charged. Yeah, I do a lot of travel, a couple hundred days a year. But and I'm usually the only Canadian in the room when I'm offshore, like in the Middle East or Asia or whatever. But our thing is to bring ideas into Canada that people haven't seen before. Sometimes it's GPs, like ones in Switzerland or France or what have you, or family offices from around the world, pension plans, and also the export. What we have a lot of great talent. Obviously, like I say, everybody in Canada that's a PM has their CFA. We're starting to punch toward our weight in the venture and private equity side. That's starting to come around. And then our Maple model, which here we just got to go, what do you mean you're not 100% funded in your pension plan? There is a plan in Florida that's 17% funded. Oh, no, sorry, 14. That's the lowest I've heard. Before it was only 29%. But all of our plans are 100 to 120% because of the Maple model, I think, because use of alternatives. In the US, they have the Yale model. They have a few other things, but using alternatives in a smart way can really help your portfolio and give you kind of like this all weather thing that people really love. Good.
So let's see if you can, since you threw the phrases around, maybe you can explain what is the difference between the so-called Maple model and, for instance, the Yale model?
Well, the Yale model is doing a lot with private markets, which Canadian plans do as well, finding inefficiencies there and really doubling down on a lot of things. And then that was done by David Swenson, and he had the whole book that he wrote. So you have that's been a thing, and it's more for the endowments. It's great for normal investors. It might be tough to implement because we have a definite timeline. You and I will go in the next 30, 40 years. Like, it's pretty much guaranteed. But then if you're thinking for legacy, for family offices, for those that are thinking in multi-generations, it gets to be more toward an endowment. But even then, endowments have this nice thing of not having a personality attached to it, where families, they do. And it also gets larger with kids. So the Maple model, though, and that was started by Claude Lamoureux. We've had to speak quite a few times. I had to speak actually in Geneva a couple years ago. And the idea there is that, sure, yeah, there's lots of alternatives, which was not done in 1990 when they started, for sure. But also this idea of no government interference. Governments cannot even tacitly say, hey, John, as CIO of this plan, we'd like you to take a look at this project. No, that will not be even entered into. They pay people what they need to pay them. They're competing with BlackRock, not with the post office, giving them LTIPs, like long-term incentive plans, bonuses, all these things that on the face of it, you're spending money. Oh my God, but you're getting top talent that can, if they do a good transaction, then they can place the money very well. And instead of having highly volatile stock market returns with bonds that correlate every few years, as we've seen, you can get longer term things like buying airports and such, which can be controversial. But if you make one transaction and pay a couple percent and hold it for 50 years, that's a pretty good amortization of the fees. And you have a long life. The CPP is the longest life asset you can get. It's the country forever. And it's moving its way toward funded, which is the most of any Ponzi out there. So, I mean, everything else is pay as you go. We're actually trying to get a funded national pension. And of course, teachers and everybody else is 100 to 120%. Because they don't go down these paths of, oh, this looks like a good idea. No. It's there's a few other things, like no outside people doing the investment plan. It's all internal people, knowing what your liabilities are. So knowing, like, not making up fairy tale scenarios where, oh yeah, we're funded. No, you're not funded. Like them being really realistic with that. So there's a few things that I'm surprised aren't done everywhere, but maybe that's a little xenophobic or something, but nationalistic. But yeah, it just makes sense. It just makes sense, as some farmers would say. Anyways.
Okay, so let's, one thing I wanted to clarify is I'm a portfolio manager, but I'm not a CFA or even a CFA1 because I'm a CIM. That's the other way that you can
That's the other way. Thank you.
So I'm a CIM. I'm a certified investment manager, and that's the other way you can become a portfolio manager. And ironically, working with a portfolio manager is another way that people who might otherwise not be accredited might get access to alternative assets. So that's
for sure
an important distinction that I think might be worth mentioning. Let's talk about alternatives in terms of their space. As you know, right now, as listeners probably know, alternatives have largely been the domain of endowments and foundations and pension plans, and are not really used particularly widely by retail investors. So I'm wondering, James, if you can tell me what you think the future might hold for the use of alternative investments for ordinary mom and pop investors that might be fairly well-to-do, not multimillionaires, but just, upper middle class people, professionals, but perhaps professionals who are working with a portfolio manager and as a result are accredited by definition.
Yeah, so there's two things, and this has really changed. I mean, finally after 20 years, the world's playing into my hands here. Alternatives are coming around. These are offering memorandum products, the non-mutual funds, non-prospective stuff that people buy, which you need to have a portfolio manager and accredited investor or accredited investor designation for the investor. Those are growing like crazy. Like there's platforms out there that can get them into your accounts fairly easily. And before it was like a mound of papers to fill out. Now it's a short amount, maybe. You know better than I do how much paperwork you have to do, but it's getting better. And then, look, when I started in 95 at DS, doing securities there. And if I want to buy a mutual fund, I just put, AIC 101 or whatever to buy the Advantage fund. Of course, everyone was buying. And it would just bang, John owns the fund. Fantastic. Now you're starting to be able to do that with alternatives, which is kind of cool. There's these products so they do have downsides sometimes or challenges, like evergreen funds on underlying structures that are not meant to be evergreen, like they're illiquid, it's hard to price, these types of things. That leads to, in some cases, gating, which means you can't get out. You can, oh, I want to get my 100 grand, John. You're like, oh, we can get you 5, or we can get you 0, or we can get you like 20 or whatever. Then they're like, I thought I want all my money. But that when you're dealing with illiquid investments, that's something that has to be internalized in the investor, not just the advisor, to know that this is something that's truly locked up, like your pension plan would be. Like it's out there somewhere. You can generally get at it, but it's not like a GIC. Even GICs have non-redeemable functions. So, like, if you buy a non-redeemable GIC, you don't expect to get out of it without paying a hefty price by selling it to a desk. The other side that we worked on for 6 years, actually, it started in 2013. Most people say 2016. But in 2019, the liquid alts rules were promulgated. They had already been issuing some funds. I think there were about 25 funds already by the time it was officially out, which is totally legal and allowed. Those are now 85 billion. We have on our site from Second Engine. I was keeping the stats myself, which was a bad idea because that's a lot of work. And now Picton has great, and Second Engine have these great. So those are technically mutual funds, not non-prospectus offering memorandum. They're literally mutual funds. They can have a $500 or a $1 minimum or 20 grand, whatever they like. They are using hedge fund strategies. So not illiquid, not private equity, not real estate, not venture. These are liquid alts. People talk about putting illiquid strategies in liquid alts. Like, no, that is not the intent here. The intent is to have liquid. So long, short, long equity, long and short stocks, arbitrage or long, short credit, which is basically the manager's skill of buying and selling either within a company's different types of bonds that are on offer, preferred shares, or between companies, and also typically, but not in all cases, using a derivative to get rid of all the interest rate risk. The largest risk of any bond fund is duration in many cases, because you usually don't have a lot of credit risk, but you have these, if you get rid of the interest rate risk, then you're just honing in on how good is this manager. They're not taking bets on interest rates, which you can't forecast anyways, typically, to a large degree, like month to month. And so you're looking at how good they are as a portfolio manager, and they can do as good or poorly in a rising rate environment as a lowering one. So that takes away from the probability or the chance that you'll have both your stock and your bond portfolio heading down, which happened in 2022. It's happened a lot more lately because of inflation spikes. Before, when stocks went down, bonds went up. Now, not so much. And who knew? No one knew these things were going to happen, and then they suddenly did. Well, someone did, I guess, but yeah. And it's like, oh crap! Now I got to rethink everything.
So let's talk a little bit more about rethinking things. What you didn't touch on that I wanted to see if I can draw out from you is maybe your views on what the role of alternative assets will be for retail investors over the next, let's say, 5 or 10 years. How do you see that playing out, given that it's been the asset classes, plural, are being democratized and being brought to ordinary retail investors? Do you see that sort of stalling, or do you see it growing, and why not?
I mean, when I started, I used to run AIMA for 7 years. When I started 2011, we had a lot of managers who said, geez, James, if we could just get our products on the bank shelves or on the dealer shelves, God, we've got so much great stuff. We have fantastic talent. We have great returns. We have little correlation to all the stuff that they're holding. Why can't we do that? And then those have opened up with the democratization with liquid alts. So that whole hedge fund strategies. For the illiquid side, these platforms that get the piping into the dealer platforms, which I imagine you can get almost anything you like now. before when I was 98, I saw a hedge fund go across my desk and I was like, geez, I can't buy this thing. Like this is offered for 6 weeks. I don't have time to do that. So those things are the structural changes that have happened over the last 15, 20 years that have really, really changed things. And there's no real putting the genie back in the bottle here. And what I've seen in the institutional world, if you look at like the teachers, Ontario teachers and such, they've had a few different models, but at first, they were like, oh, we have this bucket of alternatives, which is these different things, whatever, it's doing these things. And then now it's like, you know what? We have equity and we have bonds. The equity is made up of listed stocks for liquidity. You'll have private equity. You'll have some venture. You have long short hedge funds. You have these catalyst funds or merger arbitrage. And then the liquid, the fixed income side. Yeah, we have bonds. Of course we have bonds. Yeah. And then they also have long short credit funds. They'll have private lending. They'll have all these things. So it's just another way of getting exposure to different return streams. Well, in CAIA parlance, back in the day, like in the like 2010s or so, they came up with this alternative beta. So we always talk about beta of the market, the S&P or the TSX. Okay, that's one. But then there's all these alternative betas, which are interest rates, which is the other markets, how they move, or changes in factors. There's factor beta. And then there's this thing called skill, which you can, like I say, you can really kind of see in the alternative side because they kind of get rid of a lot of the risks. They can get rid of some of the other risks to just show the ones that I'm really good at telling you which credits are going to do well over the next 4 or 5 years or 2 to 5 years. Okay, great. Well, if they make money, they'll go, okay, I guess you can do that, obviously, because you're making money at it. The market will tell you whether you're good or not. And those types of things can really show who the better managers are versus the mediocre, the indexers, or the really crappy ones too. I mean, there's some that just can't make a trade to save their life.
So here's where I wanted to go. One of the things that I talk about a lot is that retail investors, I believe personally, would benefit from a more pension style approach to portfolio construction and management. But as you pointed out, there are constraints in terms of liquidity and matching the time horizon and the risk profile that may or may not necessarily match up as well as traditional stocks and bonds. So what's your take on the future of portfolio management? And do you believe retail investors with just an ordinary RSP and TFSA would benefit from more of what I would call a pension style approach, which is to say a larger allocation toward alternatives than has historically been the case?
Yeah, I mean, my short answer is yeah, of course. Like they have little correlation. So the thing with any investor is emotions. So you can have the best portfolio in the world, your emotions will destroy it in no time if you don't know what you're doing. So having the idea of what you're investing is internalized, knowing that, like I say, that pocket of money maybe is this 10 or 15% or whatever it might be, that's in an evergreen fund that we can treat that as liquid. So that's not something we're going to go after at any time. We have a liquid portion that we can work with. Having the usual things like stocks and listed stocks and bonds for that liquidity, knowing that they can go down, but that's better than having everything in there, because what you need is times when, if things are heading down in the public markets, having something else that can spool up and make you some money. I think it's working with the expectations of that. The liquid alts was great because all these mutual funds are available in your TFSA and your RSP. They're all as long as they're trust and they have 150 investors, you're good to go. And I think they're even working on the 150 part. We actually we're introducing not proposed legislation, but ideas, comments that why wouldn't you be able to have private equity funds and other things in your RSP, which you can't. I thought you could already, but you can apparently. So why wouldn't you allow that sort of thing in there? Because the pensions can do it. And that was one of our points. All the pensions are into these things. Now, they have expertise and timelines that are different from a retail investor, but having something, if you're 22 years old or 30 years old, why wouldn't you have a 10-year fund in there? Like, you're not going to use it. And if you are going to use it, maybe to start a business or whatever, if you're going to rip out your RSP, then okay, don't do that. But if you're thinking you're going to touch this money in 60 years, or when you're 60, then that's just another tool you can use in your planning and perhaps get some better returns.
Okay, so you've done a really good job, in my view, of pioneering alternative investments and connecting people, not just in and throughout Canada, but around the world, to help people understand the role of alternative investments. And I want to thank you for that, because I believe it's an important thing in the way people go about portfolio construction. I think it will be an increasingly important part of portfolio construction down the road. I'd like to end with the question that I ask all my guests, and that is, the podcast is called Make Better Wealth Decisions. If it was up to you, James Burron, co-founder of CAASA, the Canadian Association of Alternative Strategies and Assets, what advice would you give people to help them make better wealth decisions?
Starting by having a good advisor, because you can study all you like, and you can make your own decisions. Obviously, it can be done, but most people have a day job that's going to take their mind off things, and they won't be able to watch things. And you see this all the time when things ramp up, like in Korea, through 200% growth in the stock market there because of two stocks. You should know what that is and how that works. Maybe you don't have time to do. So you having a good advisor helps, because that's someone who you do that all day, every day. Like people, that's all you do. You did your CIM, or you do your other designations, and that's your only thing. You don't have a dentistry practice on the side, sort of thing. So, but that's key. And then someone that can explain things to you instead of just buy this thing. All right. I mean, maybe that's your stop. Maybe that's cool. Maybe you don't want to spend 1% of your life on your investments. That's cool too. But when problems happen, like I say, having internalized how things work and what to expect really goes a lot further than just having some sort of PDF that someone sent you, and you finally look at it when things are down. You're like, oh yeah, it says here I could have lost all my money. I didn't really read that. Like, what the heck? What? So it's I should say all your money, but yeah, these things have risks. Then things move around. It's like everything else. You buy a house, you get a home inspector, you get someone to actually take a look under the hood of your car. When you're buying a car, I've had some really good experiences, usually positive. That I'm getting a better car than I thought, because the mechanic says this thing rocks. You're paying way too not enough for this car. So having someone that's all they do, they're just a mechanic, they're just a home inspector, they're just a dentist or whatever, rather than DIY your whole life away.
All right. Thanks for your time, James. It's been a real pleasure. I want to wish you good luck in all you do, and thank you for all you've done even till now.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.